Picture a country that spent 30 years doing something every economist said was impossible. It kept interest rates at zero. It printed money on a scale that would make a banana republic blush. It bought its own government bonds until it owned more than half of them. And nothing broke. Markets kept functioning. Inflation stayed quiet. The country stayed rich. The world watched. Central banks took notes, and then, quietly, without a dramatic headline, something started to shift. Japan is breaking, not loudly, not dramatically, the way a bridge breaks before it collapses. A hairline fracture here, a groan under pressure there. And the reason this matters to you, wherever you live, whatever you own, is that Japan was not just running an experiment. Japan was the experiment everyone else copied. In 1990, Japan's economic bubble burst. Property prices that had doubled over a decade started falling. Banks held loans worth more than the assets backing them. Companies stopped investing, consumers stopped spending. Growth flatlined. The government borrowed to stimulate, then borrowed more. And when that didn't work, borrowed again. The country entered a new kind of economic purgatory. Not depression, not recovery, just stagnation. Economists called it the lost decade, except the lost decade became 2, then 3. And Japan kept borrowing through all of it. Today, Japan's national debt stands at roughly 260% of its GDP. To put that in terms that actually land, the United States, which everyone agrees has a serious debt problem, sits at around 120%. Japan is more than double that, the most indebted developed nation in recorded history by a considerable margin. By every conventional measure, Japan should have faced a debt crisis decades ago. Interest rates should have spiked, the currency should have collapsed, inflation should have spiraled. None of that happened, and understanding why is the entire story. The Bank of Japan crossed a line most central banks treat as sacred. It started buying its own government's bonds. Not as an emergency measure, as the entire plan. This eventually became something called yield curve control, introduced in 2016. The Bank of Japan announced a target for the yield on 10-year government bonds and promised to buy unlimited bonds to defend that target. Unlimited. That word deserves a moment. The central bank of the world's third largest economy told global markets, "We will print as much money as necessary to keep our government's borrowing costs exactly where we want them. You cannot bet against us because we have infinite ammunition." And for a while, it worked. Yields stayed capped. The government borrowed cheaply. Everyone was calm. The rest of the world watched carefully, because if it worked in Japan, maybe it could work everywhere. Then, 2022 happened. Inflation came roaring back globally. The Federal Reserve raised rates at the fastest pace in 40 years. Every major central bank pivoted hard to tightening. Everyone except the Bank of Japan. Japan kept buying bonds, kept rates pinned near zero, and this created a gap, a very large, very consequential gap. When you can borrow in Japan at near zero rates and invest in the United States at 5%, you make money. Traders had been doing this for years in modest ways, borrowing cheap yen and deploying it into higher-yielding assets globally. The strategy is called the carry trade. But this gap was not modest. It was the largest interest rate differential between Japan and the United States in modern history. Trillions of dollars, by some estimates, borrowed in yen and invested in American stocks, bonds, and real estate. The yen collapsed. At its weakest, it took around 150 yen to buy $1. Japanese exporters cheered. Japanese consumers who import most of their energy and food quietly suffered as costs rose and purchasing power eroded. Here is the uncomfortable math. The Bank of Japan cannot hold this position forever. In 2024, it began raising rates, slowly, cautiously. But the direction had changed. And when it raised rates even slightly in August 2024, the carry trade began unwinding. Investors who had borrowed cheap yen sold the assets they had bought with it. American stocks, bonds, emerging market positions, global equity markets dropped sharply within days. Japan's own stock market suffered one of its worst single-day crashes in decades. This is the mechanism that makes Japan's situation globally dangerous. It is not just that Japan has a domestic problem. It is that Japan's problem immediately becomes everyone else's problem. because the money Japan exported into global markets has to come home. Now, consider the debt at rising rates. Japan currently spends roughly a quarter of its entire national budget just servicing its debt at near zero rates. 1/4 of all government revenue, before a single school is funded, before a single pension is paid, goes to the debt. Now, imagine rates rise to 3%, not dramatically high, just 3%. At that level, interest payments on 260% of GDP worth of debt would consume something approaching half of all government revenue. Every school, hospital, defense budget, and pension all competing for the fraction that remains after the debt is fed first. The math is not ambiguous. It does not require sophisticated modeling, it is arithmetic. The only question is how Japan threads the needle between letting rates rise enough to contain inflation without letting them rise so far that the fiscal position collapses inward. There is no clean answer. Every option carries a cost that has been deferred so long it is compounded into something with very few good outcomes left. Zoom out and the global picture becomes genuinely unsettling. Japan is the world's largest creditor nation. Japanese investors hold more foreign assets than any country on earth. American government bonds, European corporate debt, infrastructure across Asia. When Japan tightens, that money moves. As domestic rates rise and the yen strengthens, foreign assets become relatively less attractive. Capital flows home. The rebalancing is not optional, it is mechanical. This happened in miniature in August 2024 and briefly rattled every major market on Earth. The full version, if Japan is forced into a faster or disorderly tightening, would be significantly larger. Total Japanese foreign asset holdings run into several trillion dollars. What the Bank of Japan is attempting now is one of the most technically demanding maneuvers in central banking history. Normalize rates without crashing the bond market. Let the yen strengthen without destroying exporters. Manage the debt without triggering a fiscal spiral. And do all of it gradually enough that the global carry trade unwinds cleanly rather than violently. Every objective is achievable in isolation. Achieving all of them simultaneously without a feedback loop emerging somewhere in the system is an entirely different problem. And here's the part that rarely gets discussed. Other countries did not just observe Japan, they used it as a template. When the 2008 crisis hit, the United States deployed quantitative easing, a policy Japan had pioneered. When the pandemic struck in 2020, governments everywhere ran deficits that would have been considered reckless a generation earlier, partly because Japan seemed to prove that high debt and cheap money could be sustained indefinitely. The implicit lesson was, borrow heavily, print aggressively, and defer the consequences as long as your central bank is willing to act as the buyer. Japan may now be demonstrating that the consequences were never eliminated, only deferred. And deferred consequences do not disappear. They accumulate interest. The strange thing about this story is how quiet it has been. No villain, no fraud, no single catastrophic decision, just choices, each defensible in the moment, accumulating over 3 decades into a situation with no clean exit. A country that aged faster than it could grow. A government that borrowed because the alternative looked worse. A central bank that printed because the alternative looked worse. Japan has spent 30 years being the exception to every rule. Maybe it manages this transition too. But somewhere in a trading room right now, someone is modeling the scenarios where it doesn't. And whatever those numbers look like is probably what keeps certain very senior people in global finance quietly awake at night. The slow collapse no one warned you about is not a single moment. It is not a crash you will see coming with a headline and a red ticker. It is a process, and it is already underway.